All right, let's dive right in. We've got news coming out of Mumbai. Uh, Thursday, June 12th, 2025, the Reserve Bank of India, the RBI, well, they dropped a pretty significant update.
Yeah, big one. It's about something most of us deal with, maybe sometimes not so happily. KYC, know your customer.
Exactly. They've announced amendments to the guidelines, and the general, chatter is that it's meant to make banking life smoother for you.
That's certainly the aim, yes. These changes, they sort of build on the 2016 KYC directions, and the focus seems very much on, well, easing the process, especially for people who've hit roadblocks before.
But, whenever regulators try to simplify something this complicated, you always wonder, right?
Yeah.
Is it actually making it simpler or just adding, I don't know, new steps, new confusion?
That's always the million-dollar question, isn't it?
And KYC. Let's be honest, it's necessary, vital even, but often really frustrating.
It is, that whole mandatory identity check thing. It's crucial for stopping fraud, money laundering, keeping the system clean.
But for the average person, sometimes it feels like jumping through bureaucratic hoops just to get to your own money.
It's the gatekeeper, really. It has to align with big regulations like the Prevention of Money Laundering Act, the PMLA from 2002, but actually doing the update, especially if you're far from a branch or the tech is just clunky.
Yeah, that's been a real pain point for so many people.
Definitely.
So, okay, our mission here in this deep dive is to cut through that. We've looked at various sources talking about these new amendments.
Right.
And we want to pull out the really key bits, the important stuff, so you can get a clear picture of what's actually changing and, well, why it matters for your bank account.
And there are some interesting details in there. Things like doorstep banking may be becoming a thing, especially in rural areas.
Right. And relaxed timelines, reminders banks have to send. Some genuinely surprising stuff.
It feels like a pretty broad attempt to fix some long-running issues in how KYC has been implemented.
So, the big question first, why now? What's the trigger for shaking up the rules at this moment?
Well, based on what we're seeing, a huge driver seems to be a massive backlog, just a mountain of pending KYC updates across the whole banking system.
A backlog, okay. So, accounts where people just haven't managed to update their details.
Exactly. The RBI even flagged this specifically. We're talking a large number of accounts needing that periodic update. And it's apparently a particularly big problem for accounts tied to government welfare schemes.
Like direct benefit transfer, DBT, or electronic benefit transfer?
EBT.
Precisely. And especially, it seems, the Pradhan Mantri Jan Yojana accounts, the PMJDY ones.
Okay, right. The PMJDY scheme. That was huge for financial inclusion, wasn't it? Brought millions into the banking system for the first time.
Tens of millions. A massive step. But think about it. If those accounts, often held by vulnerable people relying on them for subsidies, pensions, whatever, suddenly stop working because KYC is out of date.
It completely defeats the purpose. Utterly. Imagine you're living somewhere remote. Your PMJDY account is your lifeline for government support. Your KYC from, say, 5 years ago is technically expired. The bank asks for an update.
But getting to a branch might mean losing a day's pay finding transport.
Exactly. Or it's just geographically impossible. And if you can't update, your account gets frozen. You're locked out of your own funds, your benefits. That's been the reality for too many. A massive barrier.
Wow. That sounds less like security and more like, well, an access problem for the very people who need the system most. It's like building a bridge, but put in the toll booth 50 miles away.
That's a good way to put it. And experts like Atul Gupta over at Cash Repayments, they've pointed out these changes are specifically aimed at ensuring the continued availability of financial services. The focus, he noted, is really on easing the burden, especially in rural and semi-urban areas.
So keeping things working for everyone, not just city dwellers, while still managing risk.
Right. It's about making sure the system serves all its users effectively.
Okay, so the why is clear. Tackle the backlog, help inclusion, reduce friction, especially out in the villages. So what are they actually doing? What are the standout changes?
Well, one of the biggest and potentially most transformative things, especially for rural India, involves these figures called Business Correspondents, BCs.
The BCs. They're the local agents, right? Often working with NGOs or self-help groups, acting as the bank's feet on the ground in remote places.
That's them, the front line where there aren't physical branches. They handle basic stuff, deposits, withdrawals, checking balances.
All right.
And now, under these new RBI rules, these BCs are being specifically empowered to help with KYC updates.
Help how? Just collecting forms.
More than that, helping customers submit self-declarations, yes, but crucially, also facilitating biometric eKYC.
Hold on. Biometric. So a BC in a village could use a fingerprint scanner or something and help someone complete their KYC right there without needing to go to an actual bank branch.
That's exactly the idea. Instead of that long, costly trip to town, losing wages, standing in line, you could potentially just go see your local BC. They could guide you through the steps, capture the biometrics with, say, a handheld device. It's basically taking KYC out of the branch and into the community.
That feels like a genuinely massive shift, really trying to bridge that distance gap, moving the process to the customer.
It leverages that existing huge network of BCs to tackle the backlog and make ongoing updates easier. It could dramatically improve access for millions, making KYC almost as easy as, I don't know, visiting the local shop.
Sounds amazing for inclusion. But wait, BCs aren't bank employees, are they? Does that raise questions, like about training, security?
Absolutely. And that's the crux, isn't it? The success hinges on implementation. Banks now have a huge responsibility to train their BC network properly.
Right.
They need to understand the rules, the tech making sure those scanners work reliably, are secure, and critically handle sensitive biometric data super carefully. How do you ensure consistency and security across thousands of agents not directly on your payroll?
Yeah, that's a huge operational challenge.
Yeah.
The RBI is putting a lot of trust in the banks to manage this distributed system.
They are. It's a major undertaking.
Okay, so empowering BCs is a big piece. What else is changing?
Another key area is tackling that frustration of accounts suddenly being frozen because KYC is overdue.
Yes, the sudden lockout.
Banks are now mandated to give clear advance warnings. Specifically, they have to send at least 3 separate reminders before they can take action like freezing an account.
3. Okay, that feels much fairer. Like a 3 strikes rule.
It does. And here's a detail that sounds a bit old-fashioned, but seems quite deliberate. One of those 3 reminders must be a physical letter.
A letter through the post.
Oh.
Seriously. In 2025.
I know, right? It feels a bit like a throwback. But the thinking seems to be acknowledging digital overload. Emails get lost in spam, texts get ignored.
True. Push notifications get switched off.
Exactly. A physical letter landing on your doormat. That's harder to miss. It cuts through the digital noise. It's a nod to the fact that not everyone lives online or checks notifications constantly.
That actually makes a lot of sense. It's a tangible nudge.
Yeah.
It feels like they're really trying to give people every chance before bringing down the hammer.
That seems to be the clear intent. Move away from sudden, punitive action towards clear, repeated communication.
And speaking of avoiding drastic action, that whole account freezing thing, it caused so much stress. We heard about cases like M. Ramachandran, right? A retired RBI official himself.
Yes, his case was highlighted. His account got frozen even though he thought he'd submitted everything needed. It showed how kind of arbitrary bank actions could feel.
Definitely.
And that ties into the third major change, offering more flexibility, especially for customers the banks consider low risk.
Low risk?
Yeah.
Okay, so people with regular salary accounts, pension accounts, standard savings.
Yeah.
Not doing anything unusual.
Pretty much. If your account activity is predictable, standard stuff, and the bank classifies you as low risk based on their own assessment, the new rules offer a significant breathing space.
How so?
Banks can now let you keep using that account even if your periodic KYC update is technically overdue.
Seriously? That's huge.
Sure.
So your access won't just get cut off the second the deadline hits.
Not if you're low risk, according to these rules.
Right.
There's a buffer. The bank still needs to get your KYC updated eventually, but they have a much longer, more relaxed timeline. They need to get it done within 1 year from when it became due, or by June 30, 2026, whichever date is later.
Okay, wow. So you still have to do it, but the bank has potentially up to a year, maybe more, to sort it out with you. That's way better than instant account paralysis. Gives everyone time.
Absolutely. It directly addresses situations like Mr. Ramachandran's, where someone thought they'd complied, or maybe missed one notice, and suddenly, boom, account frozen. It felt overly rigid. This provides a much-needed safety net for the average customer.
So you're not immediately treated like a suspect just because some paperwork is late. But the bank's still watching.
That's the balance. You get flexibility, but the bank still has to monitor transactions in these overdue low-risk accounts. If your activity suddenly changes big, unusual deposits start showing up. For instance, the bank can and likely will demand the updated KYC immediately.
Right.
And they can take action if you don't comply then. So it's flexibility, but not a free pass. And remember, that low-risk label, that's decided by the bank's internal criteria.
Oh, that's a key point. We don't necessarily know exactly how they define low risk or what triggers suspicion, so there's still some bank discretion there.
Exactly. It gives breathing room, but doesn't remove the bank's oversight power.
Hmm.
It's meant to stop the immediate hardship for most people while still letting banks flag genuinely risky behavior as PMLA requires.
These changes really do seem like a direct answer to the common complaints. The distance barrier, the lack of warning, the sudden freezes,
Yeah.
even banks misusing the process sometimes.
They definitely are. The RBI hasn't made these changes lightly. They've seen the problems. One issue they flagged back in 2024 was banks making what they called illegal re-KYC requests.
Illegal. How?
Well, it seems some banks were using the re-KYC requirement not just for compliance, but almost as an excuse to gather extra customer data for marketing, going beyond what the rules actually required.
Wow. So hijacking a security process to basically generate sales leads, that feels wrong. Like
Yeah.
renewing your driver's license and being pressured into buying insurance.
It certainly felt off to customers, and the RBI seems determined to stop that. By stressing that KYC is only for regulatory compliance under PMLA, they're pushing back against banks using it for commercial reasons.
It really highlights that constant tension, doesn't it? The RBI trying to balance things.
Absolutely.
On one side, you've got financial inclusion, making banking work for everyone, everywhere. On the other, this critical need to keep the system secure, stop money laundering, meet those PMLA rules, international standards.
It's fundamental to financial regulation. Tighter security rules are often necessary, but implementing them can feel like a bureaucratic nightmare for ordinary people. We saw mentions of, say, Mumbai businessmen like Vinod Sharma finding compliance so complex they hired staff just to handle it.
Hiring someone just for compliance paperwork.
Yeah.
That really shows the burden it's become.
It does.
And we haven't even really touched on the tech side again. Video KYC was meant to help, right?
Eh.
But that had its own issues.
Oh, definitely. Introduced back in 2021, the idea was great. Remote verification from your phone or computer. Convenient.
But the reality?
Plagued by glitches for many. Unstable video calls, problems with biometric checks, documents not uploading, bank apps crashing. It wasn't the smooth experience people hoped for.
Yeah, tech that's only reliable sometimes isn't really a solution, is it? Creates its own frustrations.
It did. So while these new rules use tech like the BCs with biometric eKYC, digital reminders, their success still depends heavily on the underlying tech infrastructure working well and banks implementing it properly.
Okay, so let's recap. We've got the drivers, clearing the backlog, boosting inclusion, the main strategies, using BCs for doorstep service, clear warnings, flexibility for low-risk folks, the regulatory backdrop, PMLOA, and the historical problems they're trying to fix. Illegal data grabs, tech fails, sudden freezes. What does this all mean going forward? What needs to happen for this to actually work?
Success really hangs on the banks and those business correspondents. Banks need to seriously invest in training the BCs, ensuring the tech is solid and secure, getting those reminders out correctly, and importantly, not slipping back into bad habits like asking for unnecessary data or freezing accounts too quickly.
And for us, the customers,
Mhm.
even with more warnings and flexibility, you probably still need to pay attention to bank messages, right? Ignoring 3 warnings in a letter might not end well.
Absolutely. It's a two-way street. Stay aware of notifications. If you're in a rural area, maybe ask about BC services for KYC updates. They're officially meant to help now.
The big hope here, I guess, is that these changes, especially the BC doorstep service and the low-risk buffer, really do help clear that backlog and make ongoing updates less painful, particularly for all those people brought in through PMJDY who struggled before.
It's definitely a significant move by the RBI to fix real-world problems.
Yeah.
But, that historical gap between good intentions and regulations and the sometimes messy reality on the ground, that's still the challenge.
So wrapping this deep dive up, the RBI's latest KYC changes out of Mumbai on June 12th are a clear push to ease the burden on customers, especially in rural India, and give low-risk folks more breathing room. They're tackling the backlog, trying to fix past issues like those dodgy data requests and sudden freezes, all while keeping the PMLA security framework intact.
The goal is twofold: better inclusion and solid security. But whether it actually feels smoother for you, that really depends on how well banks and their BCs actually deliver these changes.
Definitely, we're staying informed about your rights and the bank's duties under these new rules. Don't let those reminders stack up.
Because KYC isn't going away, it's part of modern banking. The RBI just wants it to be less of a dreaded chore and more of a manageable, maybe even seamless background process.
Which leaves us with something to think about, doesn't it? As you consider your own experience with banks. Given how fast tech evolves, how rules keep changing, and, let's face it, the historical bumps in the road with KYC implementation, those freezes, glitchy calls, weird requests, what will it really take for KYC to stop feeling like this annoying hurdle? To become just an invisible, smooth, secure part of banking for absolutely everyone, no matter where they are in India? That gap between the rule book and reality, that's the puzzle still waiting for a perfect solution.